Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
European equities at a crossroads. Record highs meet macro realities in early 2026. The Pan-European Stocks Europe 600 index experienced a week of marked volatility, hitting new record highs before stabilizing to end broadly unchanged with a marginal gain of 0.09% in local currency terms. European markets were primarily influenced by investors digesting U.S. employment data that significantly exceeded expectations, while simultaneous concerns regarding potential AI-driven disruption began to weigh on sentiment across the continent. Performance among major national indices was notably divergent. While Germany's DAX rose by 0.78% and France's CAC 40 added 0.46%, Italy's FTSE/MIB faced a decline of 0.97%. Meanwhile, the UK's FTSE 100 index ended the period on a positive note, gaining 0.74%. According to the latest estimates from Eurostat, the Eurozone economy continued its expansionary trend in the final quarter of 2025, with GDP growing by 0.3% compared to the previous quarter. This performance brings the annual growth rate to 1.5%. Among the region's largest economies, Spain emerged as the strongest performer, posting a robust quarterly growth rate of 0.8%. This economic resilience was further reflected in the labor market, where the number of employed persons in the Eurozone rose by 0.2%, a figure that surpassed analyst forecasts. Job growth was particularly concentrated in Spain, which saw a 0.8% increase, contrasting with a slight contraction in German employment levels. Despite the general growth narrative, certain regions continue to signal underlying structural challenges. In France, the unemployment rate climbed to 7.9% in the fourth quarter of 2025, marking its highest level since the third quarter of 2021. Youth unemployment remains a critical concern, with 21.5% of those aged 15 to 24 currently classified as unemployed. In Germany, data from Destatis revealed that wholesale prices rose by 1.2% year-on-year in January 2026. This uptick was largely driven by higher costs for non-ferrous ores and metals, as well as rising prices in the food and beverage sectors. Across the Channel, UK investor sentiment was tempered by political uncertainty following calls for Prime Minister Keir Starmer to resign, linked to the controversial appointment of Lord Peter Mandelson as the US ambassador. On the macroeconomic front, the Office for National Statistics, ONS, estimated that real GDP increased by a modest 0.1% in the fourth quarter of 2025, representing a 1% increase compared to the same period the previous year. While the manufacturing sector showed signs of life, construction output contracted during the quarter. However, a bright spot appeared in consumer activity, as retail sales surged by 2.3% year-on-year in January, marking the fastest pace of growth since last August. Now our insight into alternative markets. The PE Playbook for AI adoption. Strategic value creation in the next quinquennium. The landscape of private equity is undergoing a fundamental transformation driven by the integration of artificial intelligence and AI-powered robotics. Over the next 5 years, portfolio companies that prioritize deep AI adoption are projected to secure a durable margin advantage, positioning themselves to deliver top-decile returns. Consequently, successful buyout funds must now develop and articulate concrete AI strategies to their limited partners. Those who fail to recognize this shift risk significant obsolescence as the competitive ground moves beneath them. According to the 2026 Industry PE Outlook, several traditional subsectors have been identified as primary beneficiaries of this technological evolution. Segments such as defense electronics, construction technology, gaming content production, and healthcare management systems, specifically physician practice management, PPM, revenue cycle management, RCM, and medical imaging, are expected to experience the most significant impacts on margins and cash flow. Customer service and support platforms also represent a critical area where AI can move the needle. Notably, low-margin businesses stand to gain the most. For instance, a marginal increase from 3% to 4% represents a 33% surge in profit. This advantage is further amplified when competitors are slow to adapt, allowing early movers to sustain superior margins for extended periods. However, the path to effective adoption requires a comprehensive commitment from the C-suite. Bending margin curves upward necessitates a sustained 3 to 5 year full court press across essential functions including sales, hiring, finance, and marketing. For certain industries, the integration of AI-driven robotics into repetitive physical tasks is also paramount. With the proliferation of industry-specific solutions and AI robotics startups, PE owners now have access to a mature ecosystem of vendors, providing multiple options and clear market leaders. To successfully navigate this transition, leadership must establish a clear mandate from the top, fostering an environment where piloting new AI tools is actively encouraged. Implementation should begin with the most evident use cases, supported by internal tech-savvy champions who are given the necessary time and resources to experiment. Recruiting strategies should also evolve to prioritize technical aptitude and interest in AI, complemented by individual reward systems for those who drive adoption. Motivation is often highest when AI is applied to mega projects that automate large, historically labor-intensive tasks. Furthermore, firms should prioritize vendors offering robust onboarding and support, as self-service models frequently yield lower success rates. Finally, a resilient mindset is required. Initial product limitations should not deter investment, given the rapid pace of improvement, and leaders should be prepared to manage the risk of startup failure by utilizing multiple vendors or maintaining the agility to replace them quickly.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thupcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.